大家好, welcome back to Colin Invest Inc. It's shaping up to be another huge week in the markets, and I'm here to break down everything you need to know. The title of this video asks, 下周大事提前看。这个周末发生了些什么? What major events are coming next week? What happened this weekend? And trust me, there's a lot to unpack. We've got geopolitical tension simmering, AI advancements exploding onto the scene, and economic indicators flashing warning signs, and some green lights. It's a whirlwind of information, but I'll cut through the noise and give you the actionable insights you need to navigate your investments. We are going to cover the ripple effects that will keep reverberating, the ongoing and developing conflicts, and of course, the ever-present question of AI: are the robots taking over, or are they here to help? Let's dive in. So we've set the stage with a whirlwind of upcoming events and potential disruptions. Let's take a step back, then recap what happened last week, because it paints a very interesting and somewhat contradictory picture. The market, as you can see, was a battlefield of bullish and bearish news. Yet somehow, US stocks still managed to flirt with all-time highs. It's like watching a tightrope walker juggling chainsaws, thrilling, but you are constantly waiting for something to drop. We had three major factors contributing to the uncertainty. First, the specter of Trump's tariff policies continues to loom large. The market hates uncertainty, and the potential for escalating trade wars is a big flashing red light. Second, Musk's Doge plan, which, among other things, involves significant cuts to federal wages. This has people wondering about the ripple effects on the broader economy. Will consumer spending take a hit? Will it dampen overall growth? And third, we saw that CPI data, the Consumer Price Index, ticked upwards. This immediately throws cold water on any hopes for imminent Fed rate cuts. Remember, higher CPI usually means the Fed is more likely to keep rates higher for longer to combat inflation. However, and this is where it gets interesting, there were also positive developments that helped cushion the blow. The Russia-Ukraine situation, incredibly volatile, showed some signs of a potential turning point, easing some of the inflationary pressures stemming from that conflict. And perhaps more directly and valid, the PPI numbers, the Producer Price Index, actually came in softer than expected. This is crucial because PPI often acts as a leading indicator for CPI. A softer PPI suggests that inflationary pressures at the wholesale level might be easing, which could eventually translate to lower consumer prices down the line. It's a complex interplay of forces, leaving investors in a state of cautious optimism, a bit like navigating a minefield while hoping for the best. But here is where the narrative gets really interesting, and it's a testament to how quickly things can shift in today's market. Remember how we were just talking about the fear surrounding those potential tariffs? Well, that fear, it's starting to dissipate, almost like a morning fog burning off under the sun. We're seeing a significant shift in market sentiment, a move from outright panic to a much more calculated, dare I say, rational analysis of the situation. Instead of viewing these tariffs as an immediate economic apocalypse, investors are starting to understand them for what they might truly be: bargaining chips. It's high stakes poker on a global scale, and Trump is known for his unconventional negotiating tactics. He's using the threat of tariffs, the potential for economic disruption, to gain leverage in broader trade negotiations. It is a risky game, but not just a tool for destruction. The focus is shifting. We are seeing that these tariffs are primarily being wielded to achieve specific geopolitical objectives. Think of it less like a sledgehammer and more like a scalpel, still sharp, but used with much more precision. They're targeting specific sectors and countries, often with the aim of influencing political outcomes rather than simply inflicting broad-based economic pain. And crucially, this means the immediate impact on the average consumer, the person buying groceries or filling up their gas tank, is likely to be less severe than initially feared. It's a subtle but incredibly important distinction. So we've talked about the shifting narrative around tariffs, moving from panic to a more calculated assessment. But what about the actual impact on the ground? This brings us to an interesting and perhaps deceptively quiet development: the reduction in the federal workforce. Now, at first glance, this might seem like a minor detail in the grand scheme of things. But let's dig a little deeper. We're talking about approximately 75,000 federal workers accepting buyouts. That represents about 2.5% of the entire federal workforce. Imagine the scale, the accumulated experience, the institutional knowledge walking out the door. It is a considerable number. These buyouts are projected to save the government around $15 billion. And I can already hear some of you saying, $15 billion, that's a drop in the bucket. And in the context of a $7 trillion total federal expenditure, you're right. It is relatively small. the direct financial impact considered in isolation won't send shockwaves through the market. And this is a crucial, consider why this is happening. This is part of a broader push, whether you agree with it or not, towards a smaller, leaner government. It's a philosophical shift, and those shifts can have long-term consequences, albeit subtle ones. It signals a potential change in government spending priorities, a possible tightening of the belt, which could down the line impact everything from infrastructure projects to research grants. So while the $15 billion itself might not move the needle much, the underlying intent behind it is something investors should definitely keep an eye on. It is one piece of a much larger puzzle, and that is very important to remember that. So, we've seen the market grappling with this push and pull between optimism and apprehension, fueled by everything from trade policy to workforce reductions. But that's not the whole story. There are deeper undercurrents at play, and that's where we need to focus our attention, and that's precisely what we're going to do right now. This brings us to a critical juncture, a potential shift in the market's underlying momentum, and, perhaps more importantly, the looming decisions from the Federal Reserve. Remember that feeling of buy the dip that's been so prevalent? Well, according to Goldman Sachs, that sentiment is starting to weaken. It's like the tide going out, slowly but surely. They're pointing to a buildup of downside risks, a growing accumulation of factors that could put pressure on the market. Imagine a Jenga tower with more and more blocks being pulled out at some point. The whole thing becomes unstable. Now, I am not saying the market is about to collapse, but it is crucial to recognize these warning signs. And speaking of crucial, all eyes are on the Federal Reserve this coming week. We have a parade of Fed officials scheduled to speak, and you can bet every single word they utter will be dissected, analyzed, and overanalyzed by the market. The main course, however, will be the minutes from the January monetary policy meeting. This will be the deep dive. This will be a huge driver for the market. Why are these minutes so important? Because investors are desperate for any clues about the Fed's future policy path. Are they leaning towards rate cuts? Are they holding steady? Are they even thinking about raising rates again? The minutes might not provide definitive answers, but they'll offer valuable insights into the Fed's thinking. It's like reading tea leaves, but with potentially billions of dollars at stake. And here is the kicker. Wall Street is completely divided on what the Fed will do. You've got major banks like Bank of America and Deutsche Bank predicting no action for the rest of the year. On the other side, you've got Goldman Sachs and JP Morgan forecasting at least 2 rate cuts. That's a massive divergence of opinion, and it highlights the incredible uncertainty we're facing. It's like 2 weather forecasters predicting completely opposite conditions. Someone's going to be very wrong. This is where we stand now, and next we are going even more in-depth. So, we've established this incredible divergence of opinion on Wall Street about the Fed's next move. But what are they actually thinking? That's the million-dollar question, isn't it? And that's precisely what we're going to try to decipher now by diving into the absolute heart of the matter. The Fed's own perspective on inflation and, crucially, how they're factoring in the potential impact of Trump's policies. Now, remember those upcoming minutes from the January meeting. We know investors will be scrutinizing every word, but there are 2 specific questions that will be front and center. First, how committed are they, really, to the idea of future rate cuts? Are they wavering? Are they starting to get cold feet? Any hint, any subtle indication in the language they use could send shockwaves through the market. We need to understand the degree of their dovishness, if it still exists. And second, and this is perhaps even more intriguing, how is the Fed interpreting the potential economic fallout from Trump's proposed policies, particularly those tariffs? Are they viewing them as a temporary blip, a negotiating tactic, or something more fundamentally disruptive? Are they building this into their models? And if so, how? Consider this. The January inflation data, that unexpected uptick in the CPI, it throws a wrench into the whole rate cuts are coming narrative. It's like a sudden gust of wind threatening to blow the Fed off course. In fact, some analysts are now saying that this single data point might be enough to convince the Fed to pause any further rate cuts altogether. It is a change in direction. But it's not just about the economic data. Here is a political dimension here too, a layer of complexity that often gets overlooked. Think about it. If the Fed were to continue cutting rates, and then further down the line inflation didn't cool down, they might be forced to raise again. That's a politically risky scenario, especially in an election year. So a pause, a wait-and-see approach, might be the most politically expedient option, regardless of what the pure economic data suggests. It is like walking a tightrope, balancing economic stability with political pressures. It is the hotspot that everyone is looking at. So, we've been dissecting the economic chessboard, analyzing every move from the Fed and the potential ripple effects of policy decisions. But the global economy isn't just about numbers, it's about power, influence, and, unfortunately, conflict. And that brings us squarely to a situation that continues to send shockwaves through the markets: the Russia-Ukraine conflict. Now, imagine you were trying to negotiate a peace treaty, a way to end the bloodshed and begin rebuilding. You'd expect all the major players to be at the table, right? Well, in a rather stunning development, a Trump-appointed envoy for the Russia-Ukraine conflict has essentially declared that Europe will not have a seat at those negotiations. It's like organizing a party and telling the host they're not invited. This adds more of the geopolitical issues. What does this signal? It's a clear indication of a shift in the power dynamics, a potential realignment of alliances. It raises serious questions about the future of transatlantic relations and the role of Europe in shaping its own security. A bold move, and the response. NATO, the North Atlantic Treaty Organization, is essentially warning Europe to step up its game. The message is clear: don't rely solely on the United States for your defense, increase your military spending, take more responsibility for your own security. It's a wake-up call, a stark reminder that the world order is in flux. The underlying message could be interpreted as, meet Trump's conditions and maybe you'll get a voice. Meanwhile, in a development that could significantly alter the course of this conflict, senior officials from the US and Russia are reportedly planning to meet in Saudi Arabia. Think of it as a prelude, a behind-the-scenes discussion to lay the groundwork for a potential summit between the leaders themselves. Will it lead to a breakthrough? Will it ease tensions? Or will it simply be another round of diplomatic maneuvering? Only time will tell, but it's a development we absolutely must watch closely, because the implications for global markets, from energy prices to investor confidence, are immense. And that feeling, that sense of unease in shifting alliances, extends far beyond the negotiating table in Saudi Arabia. It's permeating the very foundation of the transatlantic relationship. We're seeing a real crisis of confidence, a growing sense that the old certainties, the decades-long partnerships, are no longer as solid as they once seemed. Consider this. Recent polls across Europe paint a stark picture. The majority of Europeans, even in countries traditionally considered close US allies, no longer view the United States as a steadfast, unwavering ally. Instead, the prevailing sentiment is that the US is a necessary partner. Now, that might sound like a subtle distinction, a mere semantic difference, but it's profoundly significant. It's the difference between a family member and a business associate. You might need them, you might work with them, but the deep-rooted trust, the sense of shared destiny, it's fading. Imagine your closest friend suddenly starting to treat you like a client. That's the shift we're talking about. The European Council on Foreign Relations, a highly respected think tank, has gone so far as to warn that this represents a collapse in the perception of US foreign policy. This isn't just a temporary blip. It's a fundamental reassessment of America's role in the world, and it has Europeans deeply concerned. They are feeling like the established order, that rules-based international, is collapsing. It's not alarmist to call this a potential death knell for the transatlantic alliance as we've known it. So what's the immediate response? Action urgency. France's President Macron is convening an emergency summit of European leaders. Think of it as a crisis meeting, a gathering to address a rapidly evolving and potentially destabilizing situation. The very fact that it's being labeled emergency speaks volumes about the level of concern. The exact guest list is still unclear, but the core issue is undeniable. Europe is grappling with the very real possibility of being sidelined, of having its interests and its security concerns marginalized in a world increasingly defined by great power competition. And then, my friends, has implications for every investor, every market, and every corner of the global economy. While Europe grapples with its shifting relationship with the United States and the ongoing conflict in Ukraine, another region, long plagued by instability, sees a continuation of its seemingly endless cycle of violence. We are turning, with a heavy heart, to the Israel-Palestine conflict. This is a situation where hope flickers and dies with heartbreaking regularity, and the latest developments offer little comfort. On the surface, tears a semblance of exchange. Hamas has released hostages, and Israel in turn has released Palestinian prisoners. It's a carefully choreographed dance of mutual concessions, but one that feels desperately fragile, like a kete built on sand. It is important to note that any movement in this conflict is of note, and to be watched. The United States, a key player in this long-standing conflict, has made its position starkly clear. Peace, true and lasting peace, is deemed impossible as long as Hamas remains. It's a statement that, while reflecting a particular viewpoint, offers little in the way of immediate solutions. It's a declaration of a long-term objective, but it doesn't address the immediate suffering, the daily realities of those caught in the crossfire. And in a move that to come back to calling investing to this conflict, the US has lifted restrictions on the supply of bombs to Israel. Think about the sheer destructive power of these weapons, the devastation they can unleash. This decision, while undoubtedly part of a larger strategic calculation, adds another layer of fuel to an already raging fire. It's a reminder that, even amidst diplomatic efforts and prisoner exchanges, the machinery of war continues to turn. It's a sobering reality, and one that investors, and indeed all of us, must grapple with as we consider the broader implications for regional stability, humanitarian concerns, and the ever-elusive quest for peace. From the geoland stage to the trading floor, the ripple effects of these global events are being felt across all asset classes, and one area that's experiencing particularly intense whiplash is the commodity market, specifically gold. We've seen this safe haven asset behave in some unexpected ways, and it tells a very interesting story about the current state of investor sentiment. Imagine a roller coaster climbing steadily for weeks, reaching a dizzying peak, and then, suddenly, plunging. That's essentially what happened to gold on Friday. After 7 consecutive weeks of gains, pushing it to historic highs, the price absolutely cratered. It was the biggest single-day drop we've seen in this entire bull run. So, the immediate question is, why? What triggered this sudden reversal? Well, it's not just one thing. It's a confluence of factors, a perfect storm of uncertainty, all hitting at the same time. We've got the evolving situation in Russia and Ukraine, that potential for a turning point that we discussed early, that immediately takes some of the fear-driven demand out of gold. Then you got the ongoing saga of Trump's potential tariffs, that lingering threat that's causing investors to constantly reassess risk. And of course, the ever-present question of the Fed's next move: will they cut rates? Won't they? That uncertainty alone is enough to give any gold investor pause. Goldman Sachs, a name that carries a lot of weight in the financial world, has a particularly interesting take on this. Their commodity research team points out that, purely from a technical perspective, gold was overdue for a pullback. It was in what they call technically overbought territory, meaning the price had risen too far, too fast, and was bound to correct at some point. Think of it like stretching a rubber band. It can only go so far before it snaps back. But here's the really intriguing part. Goldman Sachs poses a fascinating hypothetical question. If the gold bull market was initially triggered by the freezing of Russian assets, a move that sent investors scrambling for safe havens, what happens if those assets are unfrozen? Does the whole rally unravel? Does the foundation of this bull market suddenly crumble? It's a thought-provoking question, and it highlights the complex, interconnected nature of global markets. It's not just about supply and demand. It's about geopolitics, about trust, about the perceived safety of different assets, and it forces us to consider, what will central banks do? Will they continue their gold-buying spree, even if the immediate geopolitical threat subsides? That's the key to understanding the long-term trajectory of gold, and it's something we'll be watching very, very closely. From the global stage of politics and commodities, let's shift our focus to the corporate world, and specifically to a sector that's been generating a lot of buzz: Chinese tech stocks. This week is shaping up to be a crucial earnings period for several key players, and the results could significantly impact market sentiment, not just in China, but globally. I am, of course, talking mostly about earnings reports. We'll be keeping a close eye on companies like Alibaba, Baidu, and NetEase, among others. These are heavyweights, the giants of the Chinese tech landscape, and their performance provides a valuable window into the health of the broader Chinese economy and the ongoing recovery, especially post-COVID. What those results will be, we will have to see. But there are clues. Now, one name in particular stands out: Alibaba. Here is a strong sense, a palpable feeling in the market, that the resurgence of e-commerce is going to provide a significant boost to Alibaba's quarterly results. Think about it. As consumer confidence rebounds, as people start spending again, online platforms like Alibaba are perfectly positioned to benefit. It's like a rising tide lifting all boats, and Alibaba is one of the biggest ships in the harbor. But it's not just about the general economic recovery. Here is a specific game-changing development that adds another layer of intrigue to the Alibaba story. Apple's strategic decision to partner with Alibaba as its primary collaborator in China. Let's just take one moment and think about the power of those two names. It signifies a huge shift. This isn't just a minor partnership, it's a major endorsement, a signal of trust and collaboration between two tech titans. Imagine the combined reach, the marketing power, the sheer scale of this alliance. It's a force to be reckoned with, and it's likely to have a profound impact on Alibaba's growth trajectory in the coming quarters and likely years. We will, of course, be watching the earnings and developments closely, and that's where the story of AI integration really explodes, taking us far beyond the boardroom battles and into something truly whoa. We were just discussing Alibaba's strategic partnerships, right? Well, hold on to your hats, because what's happening with Deepseek is like the unleashing of a whole new era of personalized AI. It's a seismic shift, and it's happening right now in real time. This weekend, a very, very powerful combination has emerged. WeChat, the super app that dominates daily life in China, is currently running a closed beta. Tariffs, meaning only a select group of users have access right now, integrating Deepseek. Now, for those unfamiliar, Deepseek is, to put it simply, a game changer. Think of it like the Android operating system of the AI world. Remember how Android allowed countless phone manufacturers to build their own versions, leading to an explosion of different devices? That's the power of open source, and that's the potential Deepseek unlocks for AI. It's not a one-size-fits-all solution. It's a platform, a foundation upon which individuals, small businesses, massive corporations, even government aides can build their own to AI. Imagine the implications of that. Imagine that you are a big fan of Colin investing, and you decide to build a financial assistant based on this. Let's talk specifics. WeChat's version of Deepseek, the one being tested right now, is drawing heavily on the vast database of information contained within WeChat's public accounts. Think of all those articles, analyses, and opinions. It's like a living, breathing library of knowledge. When you ask this Deepseek a question, it's not just scouring the internet randomly. It's tapping into this curated, highly relevant knowledge base, so you get the information directly from the source. But here's the really exciting part. This isn't just limited to WeChat. Play, Zhihu, China's version of Quora, has also integrated Deepseek. So if you use their version, you are getting answers sourced directly from Zhihu's own knowledge base. Each platform, each company, each individual can essentially create their own brain, their own AI tailored to their specific needs and fed with their own specific data. And then, my friends, is where the true potential of AI starts to become clear. It's moving beyond these generic one-size-fits-all models and into an era of hyper-personalization. It's a revolution, and it's only just begun. But the AI revolution isn't just a Chinese phenomenon, is it? It's a global arms race, a sprint to the top of the technological mountain, and the competition is fierce. We're witnessing a rapid-fire exchange of breakthroughs, with each side trying to outmaneuver the other. It's like watching a high-stakes chess match, with billions of dollars and the future of technology at stake. And right on cue, just as Deepseek is making waves in China, we have two major announcements from the US side. First, the ever-present, never-boring Elon Musk is set to drop another bombshell. He's announced that Grok 3, the latest iteration of his AI large language model, will be released on Monday. Not Tuesday, not next week, Monday. And he's not pulling any punches, folks. He's calling it the smartest AI on Earth, claiming it surpasses anything we've seen so far. That's a bold claim, even for Musk. He is hyping it up to have, among other things, chain-of-thought reasoning, a very, very powerful tool. Now, what does that mean? It suggests Grok 3 will be capable of tackling incredibly complex tasks by breaking them down into smaller, sequential steps, much like the human cognitive process. It's a move towards more human-like AI, capable of reasoning and problem-solving in a more nuanced way. It's not just about spitting out information, it's about understanding and connecting ideas. And supposedly, XI is trained on synthetic data and able to review it and correct its previous mistakes. But Musk isn't alone in this. Competition is tight. OpenAI, not to be outdone, has fired back, announcing that GPT-4o, their flagship model, is getting a significant intelligence boost, elevating it to the O3 Pro level. It's a tit-for-tat, a constant push to stay ahead of the curve. This is no longer just about incremental improvements. It's about leaps forward, about redefining the very boundaries of what AI can achieve. So what's the bigger picture here? It's clear. We're in the midst of an AI arms race between the US and China, a battle for technological supremacy, and the pace is accelerating. Each new release, each breakthrough raises the stakes, pushing the entire field forward at an unprecedented rate. It's exciting, it's disruptive, and it's going to reshape the world as we know it. Are you? Yeah? Ready? So we've seen this incredible race, this relentless push for AI dominance, with new models and applications emerging faster than anyone can truly keep track of. It's like a technological Cambrian explosion, with innovation bursting forth in every direction. But this rapid advancement, this seemingly unstoppable wave of AI, inevitably brings us to a fundamental and perhaps somewhat unsettling question. Remember all those science fiction movies where the robots take over? Or maybe the automation anxiety of the Industrial Revolution when machines started replacing human workers in factories? That fear, that concern about being replaced by technology, it's not new. It's been with us for centuries, woven into the very fabric of our relationship with progress. And now, with AI evolving at warp speed, that age-old question resurfaces with renewed urgency. Are we creating tools that will empower us, that will solve our biggest problems, that will unlock a new era of prosperity and understanding? Or are we perhaps inadvertently unleashing something that could ultimately diminish our own role, our own relevance? It's the classic dilemma, isn't it? The double-edged sword of technological advancement. AI undeniably has the power to change everything, but change doesn't automatically equate to improvement. It can cut both ways. There are very real examples, and we are seeing it now. Companies cutting down jobs, and not by a small amount. There are reports, and even some I have seen myself, of companies letting go over half of their workforce. And it's not going to stop. This is the crux of it all. So is AI an angel or a demon? A force for good or a harbinger of disruption? The answer, and it's perhaps a frustratingly nuanced one, is that it depends entirely on AI at its core, is a tool, and like any tool, it can be used for construction or destruction, for creation or demolition. A hammer can build a house or shatter a window. The technology itself is neutral. It's the application of that technology, the choices we make, that determine its ultimate impact. It's a reflection of our own values, our own priorities, our own vision for the future. It's on us to ensure. So, after navigating that whirlwind of information, from AI breakthroughs to dual tensions, where does that leave us, the investors? Many are clinging to the idea of a Trump put, the belief that if the market takes a significant tumble, the president will step in with some sort of intervention. It's a comforting thought, perhaps, but it's also a gamble. It's like assuming T here is a safety net without actually seeing it. And speaking of wait and see, a quick reminder. Monday is President's Day here in the US, so the New York Stock Exchange will be closed. Enjoy the long weekend, take a break from the screens, and recharge, because when the market reopens, it's likely to be another wild ride. We here are going to have a busy week. I'll let you all go. If you made it to the end, please hit the like and subscribe button. It helps me and the channel out a lot. And if you found this deep dive into the week's events helpful, please share it with your fellow investors. The more informed we all are, the better equipped we are to navigate these turbulent times. I try my best to bring the most pressing and relevant news to you all. Thank you all for spending your time with me. I truly appreciate it. I hope to see you all back here next time. And remember, the stock market is a marathon, not a sprint, and to always keep this at the front. Investing is risky, so trade carefully. Goodbye for now, and happy investing.